Well, it was boring. Then the week started about 30 minutes ago. From New York City this morning, good morning, good morning. Inflation data coming in softer. Equities rallying hard, up 0.7%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Ferro.
Live from New York, coming up, inflation data coming in soft, raising questions about the Fed's next move as the president gets set for a victory lap at NATO. We begin with the big issue, inflation in America.
The June CPI report.
It's a critical one.
Critical.
So critical.
The Fed has been following the data.
Analyzing every detail of this print.
You'd want to see lower inflation data.
It all hinges upon one thing.
Core inflation.
The real, cookie to crack is going to be that super core measure.
Central banks want to see core inflation coming down.
There's still lots of wood to chop, so to speak.
It's going to be pretty hard to stop the Fed from hiking.
They probably have another hike left.
July is, pretty much assured.
Now comes the hard part.
It's going to be very tough to get inflation right back to that 2% target.
It's premature to declare victory on the inflation front.
It's very, very difficult for anyone to know exactly what happens from here.
Well, let's try and guess what happens from here. Joining us to discuss, Robert Sipper, PGIM, Krishna Mamani of Lafayette College. Krishna, I just want to start with some views coming into the CPI print. And gents, both of you, great to have you with us. This is what BMO said, foregone conclusion, hike in July. This is what Deutsche Bank said, hike in July pretty much nailed on. Krishna, does that change after that data 31 minutes ago?
I don't think July has really changed. I think the employment data is strong enough and other data is strong enough, even with this print, for the Fed to continue down this path. The real question is what happens to the second hike that they had indicated that is still in the works and was going to be in November, and it certainly brings that into question. But there's a lot of time between now and November. So yes, I think this is an extraordinarily good print for the Fed and Mr. Waller specifically. So I think things are working out the way they had imagined and hoped for.
Robert Tipp, are you ready to call the July hike the last hike?
No, definitely not. Our base case is that, yes, it will be the last hike. Does it feel good to get a 0.2 core CPI print? It absolutely does. Are there reasons to believe that the CPI should be coming down in the future months? There definitely are. But I think that Jerome Powell, the way he's explaining this and the way some on the Fed that may be driving the future changes on this, what they're looking at is, what's the big picture results on core CPI? There's only 1.2 in the last year. There are 2.3s, right? A 0.2 is a 2.4% annual, just arithmetically. 0.3, 3.6, all the others are 0.5, 0.4, 0.6, incredibly high inflation numbers. So if their motif is that we need to be diligent, we can't stop halfway through the fight and then have inflation, risk having inflation reaccelerate, I think their vigilance is going to be very high until they get a lot of 0.2s, but also some signs that it's going to go even a bit lower than that.
Mike McKee's had some time to get his teeth into the latest economic data. Mike McKee joins us now. Morning, Mike.
Morning, John. Well, as Robert mentioned, it's the 0.2s that are getting everybody's attention. We fall below the anticipated forecast, the consensus forecast, in both headline and core inflation. And on a year-over-year basis, that makes a big difference, with headline inflation falling to 3% and core headline at a year-over-year basis of 4.8%, both of those the lowest since the pandemic. And of course, what Jay Powell and the Fed are watching is this core services ex-housing number, and it was spectacularly low for them, rising just 0.1% in June and 3.9% on a year-over-year basis. Airline fares, I mentioned that, down 8.1%. Rental car, used cars rather, down 0.5%. Owner's equivalent rent still up 0.4, but it's been 0.5 for many months. So we're maybe starting to see some progress on the rent side. And then the question for the Fed, and you guys were already talking about whether we should see a second increase, is look at the base effects here. This is the year-over-year change in CPI, and it goes back to last year. You can see June was very high. We had a big increase in gasoline and energy prices then that completely fell out in July. So for this month, we get a base effect of much lower inflation on a year-over-year basis. But going forward, it's not going to be as easy. So as Bill Dudley was telling us on Surveillance, you could see a give back. Some of this may not. Some of this may be somewhat transitory, and we could see a give back in coming months. So the Fed's going to move probably in July. But then it's an open question about what they do. They'll be data dependent.
Mike, you mentioned the former New York Fed President, Bill Dudley. Let's talk about the current officials. Kashkari of Minneapolis speaking later this hour. Bostic speaking later on today. We'll hear from the likes of Mester as well. I believe we get the beige book from the Federal Reserve later too. Then it's on to Daly and Waller later this week. They'll speak tomorrow. Mike, are the Fed speakers right now going into this July meeting before the quiet period? Who have you got your eye on?
Well, I think you want to keep an eye on Raphael Bostic, who has already said that he doesn't think we need to raise anymore. And so he may make that case more forcefully. Loretta Mester at the other end of the spectrum, let's see if she eases off her thoughts somewhat. And then you mentioned Krishna mentioned Chris Waller. It was out here at this Rocky Mountain Economic Summit a year ago that he said we could bring inflation down without unemployment rising significantly. And that drew a sharp response from Larry Summers and Olivier Blanchard, and they went back and forth a couple of times. It looks like right now Chris Waller has the upper hand in that debate.
Pretty remarkable. 12 months ago, if you were looking 12 months out, to see CPI year over year with a 3 handle at 3.0% and unemployment somewhere around 3.5%. Mike McKee, thank you, sir. If you are just tuning in, welcome to the program. Inflation data coming in softer than expected. The core read, month over month, 0.2% month over month, down from 0.4 previously. The expectation of survey 0.3. Year over year, I gave you the headline number of 3.0%. Core, strip out food, energy, 4.8%. Off the back of that, equities off to the races, a pop, a spike, up by 0.8% on the S&P 500. Yields lower, aggressively so at the front end, down by 11 basis points. Bear in mind that in Thursday's session following ADP, big upside surprise there. The 2-year yield was through 5.1%. It's come from 5.11% all the way back down to 4.77 on my screen right now. And with yields tracking lower, the dollar a whole lot weaker. The euro against the dollar, 110.74, session highs. Bear in mind the high for this year is 110.95 back in late April. This is a 5th consecutive session of dollar weakness on the DXY. That's the latest price action for you. Robert Tip, Krishna Mamani alongside me to break down this data. Krishna, when we spoke last time around in the last week, you said something like the next pain trade could be higher yields. What's your view now, based on the fact that since then we've had a payrolls report and this CPI print this morning?
So I think the payroll wasn't extraordinarily good. It just wasn't as bad as ADP was. So I think there's not significant respite on the payroll front. I think the CPI is definitely if this trend continues, that's something that would require a bit of rethink. I think the way to think about this is in the higher for longer. I think the CPI answers the higher part. I think high is a better point than higher. I don't think the uptrend in Fed funds rate is significant from here looking forward. Whether it stays longer, I think is still open for debate, and that will require a lot of data that we saw today. And the driver would be about really expecting rate cuts at some point because core has softened and employment has softened, and we'll just have to wait for that.
High for longer. This is your view at the front end of the curve and how you push it through the curve. Robert Tip, let's have that debate right now. How are you thinking about the shape of the yield curve at the moment?
Right. So I think that, the reality of it, which Fed speaker would I watch? I mean, they're going to be watching the data, and the data is firm. You have to spin a really aggressive story to get to the easing story. And the easing story is what is keeping the longer rates lower. It's the market's fixation that we're going to return to secular stagnation. When you look at this print here today, I mean, there are some components like airfares down 8%, drop off in new vehicle prices. When you listen to the bottom-up analysis of those industries, it sounds like, you know, cars are in short supply. We had a low rent number today. The housing component was low, but it seems like there's a real shortage of housing. And then after home prices falling several months ago and then leveling off, they're headed back up. So I think people are hearing what they want to hear. There's some reason to believe the best news on inflation could even be behind us in some of these categories. So I think that we're on an excellent path for the markets. Why are stocks up? Why is risk rallying? Because volatility is coming down. The corridor around potential central bank actions going forward is narrowing dramatically. They're not moving 500 basis points in the next year. They're going to move 25, 50, something on that magnitude. They don't want to kill the expansion. That makes it a really good investment environment in general. But in terms of the yield curve shape, the middle of the curve is very expensive. So you're going to have a tendency of the yield curve shape, which is unusually concave up, drops down in the front end and then remains flat, you know, a tendency for that to very, very slowly, frankly, in the quarters or years ahead, to rise up a bit towards these central bank rates, to disinvert. Yes.
Robert, I just wanted to jump in just to share some numbers. So a 5-year right now at 4.12%. You're looking for that to gravitate towards where Fed funds is right now? You think we could be on hold for that long?
And I used quarters, if not years. And that sounds insane in this, you know, day and age in business to talk about years. But the fact of the matter is, I think we're having a failure of expectations to adapt to reality. Markets, this is a bona fide phenomena. They take a long time to catch up with reality. After World War II, it took over 2 decades for the market to realize interest rates were going up. After 1980, it took fully until 2021 area for the market to catch up with the idea the rates were stable or falling. And right now, the markets are fixated on rates coming down in the future. And I think those expectations are going to be disappointed. It's going to be a much more stable, very, very slow disinversion. Yes, a little bit of upward pressure on your 5-year yields.
Interesting.
But very modest.
Really, really interesting, Robert. Let's build on that a little bit more. Krishna, I'd love your insight on this. All I'm going to hear today is one and done. Buy equities, credit's going to be good, this is great, the Fed's going to back away. To your point, that's only one half of the story. Let's talk about the other half. What do you think about what Robert had to say?
Well, I think what Robert is saying is not too different from what I was saying, but for different reasons. So I think focusing on things that were problematic during pandemic and follow up to the pandemic, I think that part is pretty much done. I think what is really not, what hasn't changed is the labor market. And the other thing to kind of think about is manufacturing right now is in a funk. And there's an argument to be made that manufacturing actually comes back. So I think if the long end of the market, if that is going to rise significantly, and by significantly, I mean for 10 years to, let's say, go to 4.5%, I think for that, you have to see a revival in manufacturing. If we don't see that, even at current level of employment, it's kind of a difficult case to make. But a bullwhip in manufacturing is a potential case, and that's where the pain will come from.
Well, Krishna, base case, right now, manufacturing, as you say, in the doldrums, let's just call it what it is. Manufacturing's in recession, pretty much worldwide. If you look at manufacturing, you look at services, service is still pretty decent. If you had to make a convergence call right now, is it manufacturing up to services or services down?
Well, I think manufacturing up to services is the pain trade. It's not the base trade. The base trade is services coming down to manufacturing, but stays meaningfully above the funk that manufacturing is in.
What would you say to that same question, Robert?
Yeah, I think there's a lot of churning in the economy. There are about 13 million people, just under 13 million people working in manufacturing. And at the turn of the year, it was the same number of people. I think there are hotspots in manufacturing. Construction for manufacturing is booming. The IRA has led an impetus there. But, you know, there are parts of the economy at any given point in time that will be soft. Housing was very soft last year. This year, everybody's talking about office. It's not clear to me how many jobs that's actually costing. We have people talking about the inversion of the curve and the problems in the banking sector. And as a result, you are seeing a moderation in overall job growth. You're seeing an increase in jobless claims. The question is it enough to bring you below target inflation? So you have to remember, this is a fastidious Fed. Prior to COVID, you had inflation between 1.5 and 2 on the PCE. It was totally unacceptable for them. Right now, people are behaving as if a 4 or 3% inflation for trajectory would satisfy the Fed, and we have much, longer way to go. So yeah, there are soft spots in the economy here and there. Manufacturing is not big enough to drive it, and what's going, especially with the magnitude of changes going on there. But clearly there are some things going on here we're going to find out about later. Was it the increase in immigration? What exactly is driving the job growth? Is it the shortage of workers, perennial throughout the COVID recovery? Can't say what it is, but the numbers are not speaking to that, driving this down.
Robert Tipp, Krishna Mamani, fantastic conversation. Right now, equities firmer by 0.9% on the S&P 500. Let's get you some of the price action elsewhere. At the individual stock level, here's Abby. Hey, Abby.
Absolutely, John. And on that cooler CPI print, we do, of course, have big tech as a part of the rally. Nvidia as one example, up more than 1%. The hope that the Fed will be able to stop its hiking regime sooner rather than later, and valuation will stay attractive. Domino's Pizza heading to its best day in 2 years on the announcement that they have a third-party agreement with Uber. U.S. diners can order through Uber Eats and Postmates. Uber also rallying on that. And then finally, Activision. A deal doesn't get done until a deal gets done, John. Of course, yesterday the stock had its best day since January 2022 when the deal with Microsoft was announced. But now there's fears that the FTC may try to pop back in, or the CMA, the UK regulatory body, may also look for a new review of that merger.
Abby, thank you. Coming up on this program, inflation data in America coming in a little bit softer.
But I don't think it changes what they're going to do at the July meeting, because I think that they said that they're looking at the totality of the data over the last 3 months.
We'll get the view from Washington up next.
The Fed should be pretty cheered by this. But I don't think it changes what they're going to do at the July meeting, because I think that they said that they're looking at the totality of the data over the last 3 months going into the July meeting. And the reality is the economy is still doing quite well. The economy really hasn't slowed down enough to make the Fed confident that they're going to see that slack in the oil level that they want.
Equity spiking, Treasury yields dropping as U.S. inflation decelerates to the slowest pace in more than 2 years. The latest CPI print raising questions about the Fed's next move, while lending some support to the president's Bidenomics agenda. Katie Lyons in Washington has more. Hey, Katie.
Hey, John. Well, we haven't heard directly from the president on this morning's data yet, though he is busy at the NATO summit in Lithuania, so his focus may be on what's happening abroad. Domestically, though, arguably this is a very big win for this administration. Likely going to be the president when he does react via a statement or a tweet touting Bidenomics in action once more. This, of course, is really, as he's seeking re-election in 2024, what he would like to see. Inflation coming down at the same time that the labor market is still holding in there. Overall, it does seem that he is presiding over an economy that is still surprising in its strength and the trajectory in which it is heading. That doesn't necessarily mean, though, that it is reflected in voters' opinions at this point. A new Reuters Ipsos poll that was released just this morning shows the president's approval rating is still very low at just 40%. And among the more than 1,000 individuals surveyed, the economy remained their top concern, with 21% of them saying that was their most significant worry. So it is a difficult political equation for this president to make the American people recognize what is happening in the data, perhaps. It's also difficult politically for this Federal Reserve. Of course, it has been under increasing pressure, Chairman Powell especially, by some in the Democratic Party to stop the rate hiking campaign. The argument being they have done enough work in getting inflation on the right trajectory and now need to focus more on the labor market and not significantly raising the amount of unemployed here in the U.S. Of course, one who has consistently time and again come after Chairman Powell on that subject, John, is Democratic Senator Elizabeth Warren. She'll be joining us on Balance of Power this evening, and we're certainly going to get her reaction to this data today.
No doubt about it. Looking forward to that interview. Katie Lyons, Joe Matthew, a little bit later with Senator Warren. Final word now, Robert Tipp, Krishna Mamani. Krishna, as you know, it's not about where we were last month. It's where we're going to be next year. Torsten Slock of Apollo saying the policy transmission mechanism takes 12 to 18 months. Throw in the view at BNP. They say the default cycle has begun. What's happening in credit, Krishna?
Well, so I think what's happening in credit is driven by what's happening in the nominal economy. And I think even with these types of prints, the underlying growth trend for nominal economy is still close to 5%. That's not an environment where you have significant problems in the credit markets. I think for significant problems in the credit markets, either you have to have a recession or expectation that Fed is basically going to take it north of 6%. Neither of this is in the card. So I don't think credit markets are in trouble. It's just that they don't have a whole lot of tightening potential. I think they're not cracking anytime soon.
Robert Tip, final word.
I think that spreads remaining stable or coming in a bit is good enough. I mean, there are problems in your leveraged loan world. There are troubled credits out there, but by and large, I think having volatility come down, having growth continue, for many, if not most, high yield companies, investment grade companies, a lot of high quality structured product, simply earning the yield over the next year is going to result in good returns. So an unusual bull market underway. Not one where yields are going to have a big splashy drop, but just simply by having yields gone up a bunch and staying here is going to be a productive market.
Robert Tip, Krishna Mamani, two of the best in fixed income. Love to get your views on things, particularly after a print like the one we saw about an hour ago. Thank you. High yield spreads, as of yesterday, 393 basis points. Very close to the tights of the year. Your equity market open about 7 minutes away. Equity's doing nicely. Coming up the morning calls and later, a slowdown in US inflation. Fueling questions about the Fed's next move. We'll catch up with Sarah Hunt of Alpine Saxon Woods in just a moment. Inflation cooler, yields lower, stocks up by 0.8% on the S&P. On the Nasdaq, up by about 1 percentage point. That's the price action. Here's some morning calls. Citi downgrading JP Morgan to neutral, highlighting the stock's premium valuation and some credit quality concerns for the banking sector. Bank of America downgrading Cisco to neutral, seeing downside risk to earnings with consensus estimates remaining too high. And finally, UBS raising its Netflix price target to $5.25, citing positive data from the company's paid sharing initiatives. That stock is up by a little more than 1%. Coming up, airline stocks are flying. Will consumers keep spending? That's the key question for markets, according to Alpine's Sarah Hunt. She joins us next around the opening bell. Equity futures right now positive by 0.8%. Two-day winning streak on the S&P is about to become 3 at the opening bell. Equity futures right now positive by 0.9% on the S&P. On the Nasdaq 100, up by more than 1 full percentage point. Inflation data coming in a lot cooler than expected, almost across the board. Given that, stocks up, yields down. There's your opening bell. Switch up the board. Get to the bond market. Yields look like this, down 7 basis points. Your 10-year right now, 3.90. Your 2-year, let's get to the front end of the curve. Your 2-year yield has been on quite a journey. Pre-SVB through 5.08% briefly, then dropping to as low as 3.55 back in March. Then last week back through 5.1%, and this morning we're down 12 to 13 basis points. Let's call it 4.75 on a 2-year. What a trip. Given that trip, yields down, dollar weaker for a 5th consecutive session. Euro dollar 110.84. That's the high of the session right there, right now. The high of the year, 110.95, back in March, April time when the euro was showing some real strength relative to where it has been. Think about that. The trip we've been on over the last 3 months. Pre-SVB, then post-SVB, then all the way back again. Crude right now, up by 1.2%, $75 and about 73 cents. For the broader equity market, almost 1 minute into the session. Let's call it 1 minute into the session. The Nasdaq up by more than 1%. The S&P 500 up by 0.8%. One stock to watch at the open, Nvidia. The FT reporting that ARM is in talks with the chip maker to anchor its IPO. Nvidia seeking to invest at a valuation worth $35 to $40 billion, citing unidentified people briefed on the talks. Abby has more. Hey, Abby.
Hey, John, and we have so much going on this morning. That's just one of 3 reasons that we have the shares of Nvidia popping. But yes, this is one of the big reasons. The FT reporting exactly what you said, that Nvidia is in talks to be one of the anchor companies to that chip designer ARM's IPO, of course, a SoftBank company. And last year, there had been the possibility that Nvidia was going to buy ARM outright. But because that didn't happen, SoftBank is planning this big IPO that Nvidia could benefit from. The second reason, of course, that Nvidia is higher, that cooler CPI report for the month of June, sending yields down, helping out big tech. And then the third reason, John, this is really pretty incredible. Recursion, which is a microcap biotech company, it right now is up 106%. They have now today received a $50 million investment from Nvidia to accelerate Recursion's development of its AI foundation models for biology and chemistry. And on one glance, you might think, well, this is just a smaller stock, but it's actually the 5th most traded stock in the pre-market, with more action than Amazon, Meta, or Microsoft. So Recursion now on this AI investment from Nvidia, it's one to watch, John.
That's quite a move, Abby. Thanks for that. The update there from Abigail Doolittle. Let's stay on tech. Microsoft's $69 billion acquisition of Activision getting back on track. The FTC denying an injunction to delay the deal by July 18th. Microsoft President Brad Smith writes in this, our focus now turns back to the UK. We have agreed with the CMA that staying in litigation would be in the public interest. Alex Webb has more. Hey, Alex.
Yeah, it's a big day for Microsoft and Activision Blizzard. Microsoft had been trying to pull this deal through. It was very much seen at the time as an effort to boost its efforts in the metaverse. Of course, the conversation has moved on from the metaverse since then. But both of these cases in the US and the UK focus on Call of Duty, but in slightly different respects. Critics have said that Microsoft might pull Call of Duty from other platforms, such as Sony's PlayStation. Microsoft made the case that if it did pull Call of Duty from the PlayStation, the economics of the acquisition simply wouldn't make sense because it does make a lot of money selling Call of Duty to those consoles. In the UK, it's really about cloud gaming. There's been a huge push towards this. Again, Call of Duty in that space. But there had been question marks about whether the CMA, that's the UK regulator, had done enough, had prepared well enough legally. So it looks as though Microsoft's getting a second bite at the apple. And it could be that they reach a settlement, though nothing is guaranteed.
Microsoft up by 1.3%. Alex Webb there on the story. If you are just tuning in, welcome. About 3 or 4 minutes into the session, we are positive here by 0.9%. Inflation data at about an hour ago coming in softer than anticipated. That's driving a bid into bonds, so bonds rallying, price up, yields lower. That means the dollar's weaker as well against the euro, which has been looking stronger over the last few sessions. I want to turn to the retailers. Kim Kardashian may be buying back the minority stake of her beauty company she sold to Coty. The Wall Street Journal reporting this. The sale price hasn't been determined and talks could still break down before a final deal is reached. Katie Greifeld has this story. Hey, Katie.
Hey, John. Yeah, Coty shares currently up about 1% or so after that report from the Wall Street Journal that Kim Kardashian looking to buy back that minority stake in Skin by Kim. John, that is her skincare brand. It was previously known as KKW Holdings. For her initials, of course, Kim Kardashian West. Now, originally, Coty agreed to buy that 20% stake for $200 million all the way back in June 2020. And Jefferies, which has a buy rating on the stock, says that while the value of the brand is likely lower now, in part due to the suspension of that KKW branding, you're seeing Coty shares rise a little bit today because it could help in their deleveraging efforts. But Coty, it's actually crushing it year to date, John. Currently, the stock is up about 50% year to date, basically a tech stock. And if you rewind back to June 2020, it's actually up about 150%.
Katie, on the latest, Coty right now up by 1.3%. Following that story very closely, of course. Let's stick with the retailers. Loop Capital upgrading TJX stores to buy with a $95 price target, writing this. Recent store checks gave us confidence to increase sales and earnings estimates. We see off-price retailers taking market share this year, with July typically a clearance-focused month. That's stock, at the moment at least, up by 1.6%. One more to watch, Disney. Bloomberg learning the company is weighing options for its television business in India, including either an outright sale or setting up a joint venture with partners. Ed Ludlow joins us now on the West Coast. Hey, Ed.
Yeah, good morning, Jonathan, from Sun Valley. Bob Iger's here, but he doesn't want to talk about the reporting around the India unit Hotstar Disney Star platform. Remember, they lost the rights to show cricket, which is just a massive property in India in particular, to a JV or a platform operated in partnership with Paramount. You have to put this into context. The Disney Hotstar or Disney Star or television units in India generated $1.7 billion of sales in 2022. That's about 2% of overall sales. And you look at the Wall Street reaction, I think the share's now higher by a percentage point following the open. The idea is this could improve cash flow. It's been a real struggle. Subscribers and audience there and growth there was a real question when it mattered to valuations in this sector. Subscribers kind of less important now. I think only with Netflix we're still kind of micro-focused on that as a metric. But the sell side at least saying this could improve cash flow, and it's very much in line with what Iger did when he came back, right? Targeting that $5 billion of cost reduction and efficiencies to improve cash flow and the financial picture at Disney.
Trying to stay across a lot of stories, let's just pick out this one, just briefly if you can. Neil Kashkari of the Federal Reserve has put out a blog, as he often does. He usually draws our attention to that on Twitter. He says this morning: please see threads, Neil Kashkari, for my new monetary policy essay on inflation and financial stability. So indeed we will shift across the threads and find that. But Ed, there's some signal there, not because it's Neil Kashkari, because that's kind of insignificant in the grand scheme of things. But Ed, what is happening with that platform war right now?
Yeah, it's really interesting because it's not unique to that particular Fed policymaker. You know, Sundar Pichai, the CEO of Alphabet, has also introduced himself on the Threads platform. RJ Scaringe, the Rivian CEO, has been very quiet on Twitter for quite a long time, but has now kind of gone to Threads and started posting there. We're seeing that. Executives, and also really interesting quickly, John, a lot of those executives are gaining a following even as large or larger than Mark Zuckerberg himself, who I've not yet seen arrive at Sun Valley.
Interested. Ed, thank you, sir. Looking forward to your coverage through today. Looking forward to the programme a little bit later as well with Caroline Hyde. Bloomberg Technology kicking off in about 2 hours and 20 minutes from now. This is the latest price action at the moment. The S&P up by 0.9%. Following that economic data about an hour ago, we do have a statement from the President of the United States, who incidentally is speaking right now alongside the likes of other NATO members as well. I think speaking to Zelensky at the moment over in Lithuania. This is a statement from the President on the June Consumer Price Index. Good jobs, lower costs, Bidenomics in action. Anne-Marie, AMH, in Lithuania, about 10 minutes away. Look out for that. Recent economic data highlighting some resiliency in US consumers, fueling upside in travel and leisure stocks, with the airlines and cruise lines outperforming so far this year. Chris Harvey of Wells Fargo saying economic fears are getting pushed back.
We still like growth. We still like GARP. We like mid-cap GARP. We like media and entertainment. So that hasn't changed so much. We do think the market's going to broaden out here, and it's really related to the perception. I mean, not so much that the economy has changed, but just the perception on the economy and the pushback of some of these economic fears.
Joining us now to discuss, Sarah Hunn of Alpine Saxon Woods. Sarah, I want to turn to the price action, and welcome to the programme, as always, that we've seen elsewhere. In the airlines, in the cruise operators. The cruise operators year to date on the S&P 500, the performance is ridiculous. Carnival's up by something like 135%, 132 right now. Royal Caribbean up by 104%, Norwegian up by 82. Check out the airlines. It's up almost 50% across the board. United, American, Delta. Sarah, the data we've seen in the last week suggests that real incomes are starting to look better. Do you think the spending in this particular part of the economy can continue?
Well, if you think about where some of these stocks have come from, I mean, when we had the problems of the pandemic, and most of these companies, in many cases, especially on the cruise lines, had to raise a lot of money very quickly, and their equities went down in very, very large amounts from where they had started. It is very good to see that rebound, and you're seeing it in the activity because people, in fact, are traveling and doing a lot more than they were able to do for a couple of years. The question is, how long will that extend? And can they continue to raise prices? And I think that's what's going to be the biggest issue for the consumer going forward is we've had a huge amount of ability to raise price by a lot of these companies. And will they be able to keep it up? And you look at ticket prices for both cruises and for airlines, and you have to wonder whether or not that can be sustained.
There is some excitement this morning, Sarah. I'm sure you've heard it already in the last hour, that these conditions can persist. Positive real wage growth. The labour market can remain tight. Inflation can remain subdued in and around 2-3%. Is that good for risk?
That happens, it's very good for the question is that really sustainable? And I think that the issue with the labor market is you saw real wages go higher and you saw the work week go higher. Those things are going to be more problematic from the Fed standpoint in terms of where they're expecting the labor markets to go. And they would like to see a little bit more weakness in the labor market, whether or not anybody wants to say that out loud. So the question really is, can you continue to have strong labor and strong wage growth without having an impact on margins and corporate earnings? And that, I think, is where you're going to start to see some tension coming through towards the end of the year. What does that really look like, and what does that look like for margins? That's going to be an issue on the earnings front, and that is also going to be a little bit, could be problematic for risk. It doesn't have to be. It depends, again, on whether or not you have a benign cycle where I can keep raising prices because wages are going higher, but I don't have as much inflation. I think that's a little bit of a tricky one to navigate, but we'll see how that happens going forward.
Sarah, that labour cost issue, do you think that's a sector story, or is it a story within sector? Do you expect to see some dispersion within companies within certain sectors?
I think there will definitely be some dispersion, but at the end of the day, if you don't have that participation rate go back to where it was pre-pandemic, you're going to have less labor in the market, which means that across the board, wages are going to have to be higher. You're already looking at companies, the earlier story about Chipotle, looking towards more automation. You're going to see that happening because companies are now being pushed by labor costs, and they're looking to do things. So I think that is more an across-the-board story than a specific sector story. But as any sector gets weaker, you'll see wages in that sector weaker. The idea that we possibly have had sort of a rolling recession where one sector goes in and one sector comes out may be one of the reasons that the economy has looked so resilient.
We've discussed service sector winners, cruise lines, airlines. Let's talk about losers, banks. Tough year, Sarah, almost across the board. I talked about that downgrade, whatever that's worth, from Citi on JP Morgan to neutral going into Friday. We might get excited this morning about where inflation data is trending, where jobs growth is and has been over the last year. There is a belief that on Friday we're going to be very focused on credit quality, very focused on loan loss reserves. Sarah, is that your focus too?
I think there's absolutely a reason to be checking in with what's going on with the consumer. And you've already started to see some cracks in that with delinquencies going a bit higher and companies taking larger loan reserves. I think that is one of those issues that is going to be, right now, we're feeling some relief on the inflation front because of this data print. But I think as we go forward, we're really going to have to analyze what's happening with the consumer and what's happening with companies, both on the top line and on the margin line. And I think for banks, it is a very tough environment because you still have that inverted yield curve. That hasn't gone away. And I think that there are some real issues in the ability to earn money for them and the question of whether or not you're going to start to see a little bit of a weaker consumer come through on the charge-off side. So I think that there is a lot of data to focus on once we get past the CPI print. And I think there's going to be a lot of scrutiny of earnings into Q2 about what's been going on for the last quarter, because some of this CPI data is also a little bit behind. So we were talking about the owner equivalent rents, whether or not housing has gotten more expensive. I would say, as a Northeast bias, it certainly has.
Sarah, one final word on a sector you've liked but hasn't performed in the way I'm sure you would have hoped it would. Energy. What's going on?
Well, I think that the hope that rates will come down is going to be better for energy stocks because part of the issue has been higher rates, and that has been also impacting the oil price. But you've also seen a lot of supply, and you've seen a lot more supply than people expected. If the economy is going to be on a better trajectory than people had feared a few months ago, energy should start to pick up, and you're seeing prices come up a little bit higher today on that CPI print. But I think that longer term, that lack of investment is going to come through, and you will see higher and more sustainable energy costs or energy prices. You've also seen some of those stocks on the natural gas front and the LNG front start to perform much better. So we think that trend can continue.
Sarah Hunt, thank you. From Alpine Saxon Woods, Morgan Stanley just a moment ago publishing. This is what they've got to say. This month's low core print won't stop the Fed from hiking in July. Ellen Zentner and the team previously stating they think we get a hike in July. We won't meet the bar for a hike in September. 1 hour, 15 minutes ago, that inflation data changed the debate this week, at least a little bit. Equities up by 0.9% on the S&P, on the Nasdaq higher by a little more than 1%. Coming up next, President Biden preps for a NATO victory lap.
We just concluded the first meeting of the NATO-Ukraine Council, and all our allies agreed Ukraine's future lies in NATO. Allies all agreed to lift the requirements for membership action plan for Ukraine and to create a path to NATO membership while Ukraine continues to make progress on necessary reforms.
President Biden moments ago in Lithuania. That conversation with Maria Tadeo coming up next.
We just concluded the first meeting of the NATO-Ukraine Council, and all our allies agreed Ukraine's future lies in NATO. Allies all agreed to lift the requirements for membership action plan for Ukraine and to create a path to NATO membership while Ukraine continues to make progress on necessary reforms.
President Biden, moments ago, as NATO members make progress on aid and security guarantees for Ukraine. President Biden likely to frame the summit as a successful outcome of his global engagement. Biden set to speak this afternoon as that summit finishes. National Security Advisor Jake Sullivan said the president will highlight, quote, how the U.S. and our allies are supporting Ukraine, defending democratic values and taking action to address global challenges. Your team coverage starts right now. AMH alongside Bloomberg's Maria Tadeo. And Marie, first to you. A success for the president?
Well, it was a success in the sense that this is really part of his major foreign policy goal, not just keeping NATO united, but also the expansion of NATO. We had here Sweden joining. And then today you saw some reconciliation with Zelensky, who really took a sharp tone with NATO members yesterday on Twitter. But today he was really showing how grateful he is to NATO members and also the G7. The president is now with G7 leaders and Zelensky, and they're talking about long-term bilateral cooperation between all the G7 nations and Ukraine when it comes to military assistance. We should note, Jonathan, though, a lot of this potentially build back at home hasn't been a success, or maybe there's been some questions regarding the optics because the president decided to skip a dinner last night. This is kind of par for the course for the president. I've been a number of these international trips with him, and he's missed some of the dinners. And it comes at a time when Jake Sullivan was asked about it, and he said, well, he didn't think he had to go because he was going to have deep engagement with these individuals at the summit, and he has been having this engagement with them since Russia invaded Ukraine. But the issue is, Jonathan, of course, as the president tries to make this big foreign policy speech today really an argument for the American people to trust him, they're questioning a lot of things about Biden as a campaign candidate running for 2024, because poll after poll continues to show that Americans are nervous about his age.
We'll take that address a little bit later. Maria, if the president spins this as a success, do you think Zelensky would say the same thing?
Well, look, the question is, did Ukraine get everything they wanted? They did not. And of course, we should make it clear there was going to be no formal invitation for Ukraine. It's clear to everyone the country is at war. And it was clear from the beginning. Remember, the president was very clear on this on the Sunday. You cannot get into direct confrontation with Russia as NATO. That would be incredibly dangerous for the world. The real issue here was the management of the expectations, maybe the mismanagement of the expectations. But I think today we have seen a real change in tone from President Zelensky. Yesterday, he put out that tweet where he said, a lot of the arguments that I hear are, quote, absurd. We've been here before. This morning, again, repeated, we have to be on the same page when it comes to the invitation. But now you see a Zelensky who says this was a good package for Ukraine. An invitation would have been the optimal outcome when it comes to the political signal. But the country walks away, as Anne-Marie said, with a G7 commitment, with funding, with training. And again, this political declaration that they cannot join now. The conditions are not there, but the future of Ukraine is in NATO. Is it a perfect package for Ukraine? No, but I was told by a very senior European official, objectively, you cannot say this was a bad meeting for President Zelensky.
That address by the President of the United States, 12:45 Eastern Time. We'll take some of that coverage for you right here on Bloomberg TV and, of course, on Bloomberg Radio. AMH, just on the dinner, just quickly, why don't they just say the food sucks? You know, would you eat at one of these things?
I think I would, Jonathan. When you go to these international summits, the head of state that organizes it, they put their best people forward to make sure they're making a great impression. So personally, I would eat at them. I'm not sure the president's staff, though, any president wants their principal eating at these events, though, just in case.
Interesting. AMH alongside Maria Tadeo. Thank you, guys. Appreciate it, as always. About 23 minutes into the session, equities on the S&P at 1 full percentage point. We're looking at a 3-day winning streak on the S&P 500. Your trading diary up next. So far, so good this morning. Equities up for a third session at 1% on the S&P. That's the price action. Let's get to the trading diary. National Economic Council Director Lael Brainerd speaking at noon Eastern. Then the President delivering remarks from NATO, 12:45 this afternoon. More Fed speak later. Bostic, Mester, plus the Fed's Beige Book, 2 p.m. Eastern Time. US PPI and another round of jobless claims tomorrow morning. We round out the week with earnings from the big banks this Friday. Wells, Citi, JP Morgan. From New York, that is it for me. Thank you for choosing Bloomberg TV. Good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.